presentation contains current opinions of Moe Ansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Moe's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Moe.
Hello everyone and Happy New Year. I'm Moe Ansari, President of Compact Asset Management, and welcome back to the Compact YouTube update for January the 6th, 2025. First of all, we wish all of you a very happy new year. Looking forward to hopefully healthy, happy, and prosperous new year. I hope all of you had a great 2024. I'm looking forward to this year. It's going to be interesting. After 2 years of 20+ returns for the S&P, it's only happened 6 times in history, so we should enjoy that, sit back and enjoy. I think 2025 is going to depend on a lot of different things. I think more on the new administration, tariffs, inflation, interest rates, immigration policy. All of those are going to impact the markets. How those turn out and how much impact they're going to have, we'll have to wait and see, because we don't know exactly what the eventual outcome will be on all of these different things and how much exactly we are going to get on what the president-elect has promised us. Looking at, first of all, I want all of you to subscribe to this channel, so whenever I do an update, you will be notified. You can watch it at your convenience. Looking at the numbers, market was down about 0.5% last week. It's, up about 1% for the year. There's one saying that goes, the first 5 days, how the month of January goes, that goes how the month of January, and how the month of January goes, how goes the year. That's the old saying in Wall Street, so we'll have to wait and see. So far, it's been a good start so far, and we'll have to wait and see. We've got a couple of more days. It's a holiday or shortened week. We're Thursday. We are going to be closed on the 9th for President Jimmy Carter's funeral, so that day is not going to be, but we do have a lot of data coming in this week. Dow Jones Industrial is also down 0.59% for the week. We saw the Russell gain, and that was a good one. It was up 1.13%. A lot on the small cap depends on what happens to interest rates, and interest rates were down a little bit last week. Energy was the big winner last week. Again, the policy is expected to change on energy, but how much more we can produce. I think one of the areas that is natural gas, that we are going to start exporting a lot more liquefied natural gas, which is definitely a positive. Oil was up, $73 is getting closer to $200 a day. I think we are going to hit resistance, and then we'll go from there. Interest rates were about stable. They went from 4.62 to 4.6. We're sitting right at that resistance area of 4.63. I will show that to you on the charts. If we get above 4.63 on the 10-year bond, I think we're then headed towards 4.73, which was the high last year. Anything above 4.73, I think will put a drag on the market. But I think we're getting pretty close to the top in rates, and I'll talk about that a little bit later on. Looking at the 2024, the biggest winners were communication services. That's Google, Meta, and companies like that. Technology was second best at 36%. Consumer discretionary, those are companies that are basically based on retail. They did very well. Financials, which is more of a value part of the market, it did not do well in 23, but did very well in 24, up 28%. The S&P ended up 23.3% higher for the year. So it was a wonderful year. Well, now we've got to sit back and see what happens in 2025. I think it's going to be overall positive. We are going to get some tariffs, depending on how big those tariffs are, and if it does sort of seep into the inflationary numbers. If we get smaller tariffs that have no impact on inflation, we get a budget deficit, which we get with tax cuts, which is positive, but at the same time we get cut in spending from the government. That could be very positive overall for the market. So we'll have to wait and see how these different policy initiatives come out of the House and the Senate, what is agreed, how much, and then how much the president wants done, and that's what we'll have to wait and see. Looking at the data, the big number this week is going to be the private payroll unemployment data for December. It's expected to be up 160,000 jobs created. Last month has been, previous was 227, which was more than expected. If you get a number, again, we are starting to, as long as we stay in the 200,000, 200K number, that's about keeping employment even. If you get a number of 160, even though that's what is expected, that will be a slowdown in hiring or the new jobs created. And that is what the Fed is really looking at. I think the Fed at the last meeting hit pause more so by saying, look, we don't know exactly what the policy initiatives are going to look like, how much that's going to have an impact on the economy, how much that's going to have an impact on inflation. So we're going to reduce the number of interest rate cuts from 4 to 2 that is expected. But if unemployment starts to move up, I think the Fed will be very quick in continuing to bring rates down. So unemployment is what we have to watch. For the last couple of years, we've looked at the inflation number. That was the big number to watch. I think inflation, especially with housing, more houses coming on the market, inventory going up, I think 2025 is going to be a slow year for real estate, where we are going to see prices stabilize or even go down in certain areas. That'll bring shelter down, which is a big component of the inflation and contributes a lot to the inflation. That comes down, it could bring inflation numbers down. The only other part has been car insurance, and that has been one of the one of the things that has contributed to a higher CPI. I think that is going to, we'll have to wait and see how that plays out over the next. Looking at the technicals, we had a really good open today where the 50-day moving average is 59.48 and the 20-day moving average is 59.65. We're trading at about 59.73. We gapped up today above the 50-day, above the 20-day, which is a positive sign. Again, this looks like wave 3. We are in wave 4. Wave 4 was, wave 1 is down, 1 is up, 2 is down, 3 is up, 4 is down, and then we get the 5th wave, and that is up here somewhere. I haven't projected it yet, but I will next week. Put out a projection from here, from the wave 3 to wave 4 to wave 5 on the dailies on the S&P. But wave 4, which we're in right now, are known to be messy. We've got the ABC pullback. This is A, this is B, and this is C that we're in right now. We did make a new low on this pullback on Thursday. We got below this low, and so that qualifies as a C. And from here on, if we can get above 60.50, that is the first resistance, and then obviously the all-time high close to 6,100. But I expect that once we get the 4th wave completed, we're going to start the 5th wave to the upside and take us higher. Same thing on the weeklies. Once we see the 5th wave top, we are going to get a deeper correction, probably in February or March somewhere, bringing us down to somewhere around 5,800 is what I'm looking at right now, somewhere around there. That's what the projections are for the 4th wave pullback on the weeklies. But the weeklies take time. Every time we've come to the 20-week moving average since October low of 2023, came and tested the 20-week here, tested the 20-week here. We got below it, but then came back, closed above it, tested it here a few weeks later. And so we are getting close to this test. That will be the first test that we get. But first we have to make a new high on the dailies, and then we'll see the weeklies pull back. NASDAQ seems like it's just going back and forth, up and down. Came and tested the 50-day moving average at 19,260. We're at 19,840 today. Again, looking at somewhere around making a new high once we can get above the 20-day. Today we are trading above the 20-day at 19.6. We're above it. We'll have to wait and see if we close above it. Weeklies are looking like a little toppy. We'll have to wait and see. The big driver has been interest rates. As we said, at around 3.8, last year that I thought that was overdone to the downside, rallied up, wave 1, 2 down, 3 up, 4 down. Now we're in the fifth wave. 4.63 was this high right here. We are right up against it today. We're at 4.62. Last week we got above it for a little bit and then came back down. And then this high of 4.73 from April of last year, that's going to be major resistance. As long as we stay below this 4.73, even 6.3 is a good number, and then we make a fifth wave, that'll show that the top end rates are in, at least for the short term. But we have not made the fifth wave top yet. We'll have to wait and see it turn down, get below the 20-day, which is around 4.5% on the 10-year note. That, I think, is going to be the driver of the stock market is interest rates, but interest rates will be driven by the deficit, how big or small it's going to be, how much tax cuts we get, and how much revenue we cut from the government, how much spending we cut from the government. We'll have to wait and see, and what the tariffs look like. So all of that is going to work out in the next couple of months. Weeklies on the small caps, they've come back down. They made a fifth wave. That made a double top. We could not quite get above this high that we made in 2021. It's been 3 years. We've just gone back and forth, back and forth, back and forth. Looked like we were going to break out, but then we hit a top, backed off, and I think this is going to be an ABC correction, and then we can hopefully get above the 245 area. Crude oil pushing the 75 area, which is, we got close to 75 today. That is the 200-day moving average. I think oil should be headed, I think it's run up quite a bit from the 67, come up about $8 a barrel. I think we're going to pull back from here. Gold, as I said, once we got the fifth wave top, we've gone through the back and forth ABC, ABC. I think as long as we're below 2671, I still think that we are going to see somewhere around 2,500 for the gold market. Those are my thoughts. Those are my views. Again, if you need help with your portfolio, send us an email at invest@compact.com, invest@compact.com. If you have any questions about your portfolio or would need to know how do you get to where you want to go financially, we can develop a roadmap for you. So give us a call or just call us at 800-388-9700. Don't forget to subscribe to this channel simply by clicking. So whenever I do an update on YouTube, you will be notified. Those are my thoughts. Those are my views. I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moe Ansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compact Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.